Oh, howdy there, folks. Welcome into this three-piece, 3 videos up here for me to react to and give my opinions and perspectives on. First one up here, PayPal CEO Alex Chriss. We will shock the world. Okay, I'm looking forward to getting into that one. Then we're going to get into this one. Jim Liebenthal, we are likely to get a rate cut in May. Looking forward to reacting to that one. And then the last one is Tom Lee. This was actually from last night. Tom Lee talking about the market's going to go down quite a bit more, basically after this month. So we'll get into that. Appreciate everybody joining me as always. Want to get straight into this. If you're looking to apply, join my private group, get access to all my course curriculums, access to the 6- and 7-figure Discord chat, all that good stuff. Check out the pinned comment down there. We've got a lot of PayPal shareholders in there. We're talking PayPal every day. Alrighty, guys, let's get into this.
First interview since stepping into the role as the president and CEO of PayPal is Alex Chriss. It's nice to have you here. Thank you.
Thank you, David. Good to be here.
It's good to have you. The analysts don't seem to love the stock right now. It's just the last couple of weeks. I've taken a look at a few reports. Mizuho yesterday, PayPal faces competitive pressure from A to Z, downgrade. Oppenheimer, PayPal, or persistent profitability pressure has them downgrading it. Morgan Stanley, slower than expected progress on strategic imperatives. BTIG, too much uncertainty puts us on the sidelines. I mention those because I'm curious to get your response. So what do you say to these analysts to get them to change their mind, or how do you?
Well, look, we're an important company. We've got a quarter of the world's e-commerce running through PayPal. So that's why we've got 45 analysts following us. And, look, to be honest, there hasn't been a lot to celebrate over the last few years. I think innovation's been slow. The company's been growing, but hasn't been putting out real customer-backed innovation. And that's why I'm here. That's why I'm so excited about it going forward. So look, I love being an underdog. I will take all of that feedback and we'll shock the world.
Yeah, you think you're going to shock the world. How are you going to do that?
We've got an innovation day coming out.
Hold on, before we go into that a little further, okay? He says we're going to shock the world. First off, does PayPal need to shock the world to be a successful investment? Because I think that's a fair question, because there are some stocks that sometimes have to. The answer to that is absolutely not. PayPal does not need to shock the world for this to be a successful investment over the next few years. That's just a bottom line with that. It's just a very attractive valuation with decent growth. That's the story around PayPal, right? If they do shock the world and they do innovate in a massive way, I mean, that's just, cherries on top in this whole situation. And that's where you get some, insane stock price movement. But they don't need to shock the world for this to be for this stock to go to 120 or 150 or 180 or something like that. If you want to talk about going back to 300 or above 300, okay. Yes, we need to come in and shock the world and innovate in a massive, massive way.
25th, where from the first week that I got there, this was not about trying to figure out what to go do. It is very clear what we need to do. 24 will be a transition year for us, but it'll be all about execution, and it starts with innovation. So on the 25th, we're going to come out.
So 2 important things. One is the event's going to be on the 25th, showing off innovation. 2 is he described 2024 as a transition year for the company, which kind of it has to be. I mean, if you have a new CEO come in at the very end of this past year, obviously it's this first year getting things up and rolling.
Very clear customer-backed innovation that we'll be rolling out for consumers, for our merchants, for Venmo. And I think it'll be a good start to this year.
Anything you can tell us at this point? Obviously, I don't want you to ruin the rollout, so to speak, but when you say you sort of have a very clear idea of what you have to do, and then you say innovation, any specifics you can provide?
Well, look, PayPal hasn't delivered the value proposition to its consumers or its merchants over the last few years that I think we're capable of. We have more data. We see exactly what people are purchasing around the world. So we need to make a better value proposition for consumers, put more money in their pockets. For our merchants, we have the ability to leverage AI to deliver an incredible improvement in their conversion rates. And then we have to let our small businesses and our consumers connect, leveraging AI-driven personalization.
And you believe that, for example, using the data more effectively for particularly the merchant side can bring, higher profit margins? I mean, how does this translate?
Well, look, we have over 35 million merchants that are using PayPal. When we improve their conversion rate, it improves their business, it improves our bottom line. We're kicking things off on the 25th.
I mean, you do have an awful lot of data. You ever consider just selling it or working with others as well to sort of pool that data in some effective way?
The data is our customers' data. It's our consumers' data and our small businesses' data. What we need to do is leverage AI to make it better for them to be able to grow their businesses. Small businesses are under a ton of pressure right now. It is hard to be a small business in good times. It's not good times right now. We can give them an advantage. Advertising costs have gone up 2x over the last few years. We need to be able to give them the opportunity to leverage the data that they have and improve their business.
Right. All right. When you speak to investors.
So I don't know where he's going with this. He's talking about AI. He's talking about advertising costs. He's talking about giving, small businesses an advantage. So I don't know exactly where he's going with this as of right now. I'm going to have to do some more thinking about this and plotting, but I don't know exactly where he's going here.
Now, and it also is encapsulated to a certain extent in some of these analyst reports as well. Competition comes to mind. Your lack of significant profit margin expansion and/or actually lack of profit margin. Apple Pay, buy now, pay later. Do you have an answer to these? You talk about what is a still relatively dominant position, but at the same time, it seems as though you've taken on a lot of business that doesn't really have a margin associated with it.
Yeah, I think we have done too many acquisitions over the last few years, and we've been defocused. It was one of the things I noticed when I came in 100 days ago. We've got a lot of priorities. We've narrowed those down, 5 key priorities, all focused on profitable growth. And so I think you'll see us start to move away from some businesses that we may have been in and really focus our energy and our efforts on building profitable growth going forward. It's going to be a lot of fun.
Okay, he just mentioned profitable growth twice as a shareholder of the company and somebody that would like to buy more of these shares. That is something I love to hear, okay? Do I like that Alex Chris did that interview? And the answer is no. I do not like that he just did that interview with CNBC. I love that he did that interview with CNBC right there. This man needs to get out there over this next year and do a lot of interviews with CNBC, with Bloomberg, with pretty much whoever would give him an interview. I would get out there as much as possible. That's realistic, obviously, with his schedule being obviously very busy, being the CEO of the company. But he needs to get out there because one of the problems with PayPal is the story is not being understood from any angle, I think, from Wall Street right now. And that's why the stock trades at a forward P of 10. I mean, this is a company with 5 to 10% revenue growth for a long time to go in the future without even shocking the world. And we gotta just Wall Street doesn't understand it. They don't understand the story. So he needs to get out there and do a lot of interviews over this next 12 months, in my personal opinion. That's the best thing you can do when your stock is very misunderstood and the company's very misunderstood. All right, next one up here, Jim Liebenthal. We're going to listen to these gentlemen debate the markets and stocks, and then we'll get into Tom Lee and a very bearish prediction for the market for this next bit of time.
Let's realize in 23, we came in short, bearish, and expecting the worst. And in 24, we came in long, bullish, and expecting the best. And I think what's happening right now is that markets are pushing back against that narrative, as are we. I think there's going to be a lot of opportunity this year. We can talk about the playbook in a little bit, but there is a wide range of outcomes that could happen with equities. I mean, you can see a scenario where the Fed engineers a soft landing and we get to the 5,200 that Tom Lee's talking about. That's nirvana. Has to be near perfection.
That's kind of the top end of your range, too, in the best case scenario for your outlook for this year, right?
That is. And everything has to go right in that scenario. We suspect, though, that we're going to be challenged throughout the year. I think what we say is we're data dependent. So we're hanging on really every word, every data point to be able to see opportunities at the lower end of the range. So what we would tell our clients is that we want to be mindful buyers if the market gives us that opportunity to do so. And we want to be pausers because we're long-term investors. There's no question about it. We're not selling when the market gets to the upper end of the range. We're undulating the accelerator and reacting accordingly. And I think now's the time to pause and see if it's a pause that refreshes. The bond market's sending a lot of various signals, right? The 2 years specifically. And is it one of worry? Truth is, we don't know that yet.
I like that you bring it up that way. We don't know because, does the strong economy, Jimmy, mean the Fed's going to cut less? Well, what if you don't believe the economy is as strong as a retail number would lead you to believe? Because some of the other data hasn't been all that strong at all. Then we start to think about, well, what about a policy mistake? Fed stays too tight for too long. It leads you to what Waller said yesterday. And remember, he's sort of emerged as this person within the Fed that, he arguably caused this whole rally.
So, what are you hearing here? You're hearing a lot of confusion. You're hearing a lot of, they've got this problem, okay? What can you take from that? And the answer is that's actually a great thing to be investing into a market where there's a lot of concern and people skeptical and these sorts of things. I love buying in that sort of market, right? I'll be buying stocks on Friday in the Patreon portfolio in the public account. I love buying in that sort of market. The market that scares me the most is one that you don't have any confusion. You don't have any concern. You don't have any skepticism. These are all things we got a lot in this market right now. Well, what about this? What about this? Did you see this data point? That's the sort of market we're in right now, and I like that.
The end of October until the end of the year. And he now seems to have put a little cold water on the rally over the last couple of days and caused this move higher in interest rates, where he says that policy is set properly. Those are quotes. That the Fed should lower rates, quote, methodically and carefully. No reason for the Fed to move as rapidly as in prior easing cycles. It goes to where I started. We're not really sure what's exactly happening and how the Fed's going to react to it. But the market has priced a lot of stuff in.
Yeah, and I think it's safe to say that we're not sure. I'm not waking up in the middle of the night worrying about the markets right now. I will acknowledge to everyone watching that this is a heavy tape right now. I mean, no question about it. This is a heavy tape. And I think that this is just simply an adjustment to the idea that we're not getting a rate cut in March. And we shouldn't have gotten a rate cut in March, but we're very likely to get one in May. And I think the market just simply got ahead of itself. But I do still commit to my overarching belief that this is a year in which earnings matter far more than the Fed. We're talking about when the Fed's going to cut, not if they're going to cut. We're talking about the Fed cutting, not how high are they going to continue to raise rates. And that's a complete tone change in which news like today about retail sales and industrial production coming in better than expected is good news. It pushes off further the idea that we're going to have a recession or a hard landing. Both of which, they're both the same way of saying that would impact earnings, which again is critical, because if you want the rally to 5,100, Tom's at 5,200, but I'm at 5,100, you have to get that 12% earnings growth this year. To the extent you got retail sales that says consumption is strong, employment is strong, that's what I'm looking for. I'm not worried about the market adjusting to the Fed now moving in May instead of March.
Yeah, but Ginny, one of the key issues, certainly one of the key questions is whether sentiment and valuation are offsides. On the sentiment issue, where, as Rob perfectly laid it out, how we came into last year and now how we've come into this year all bulled up on everything, right? Inflation's coming down, earnings are going to be good, economy's going to be strong, stock market's going to be good. Jamie Dimon was maybe he said there was too much optimism in Davos. Let's listen.
I think it's a mistake to assume that everything's hunky-dory. And, and when stock markets are up, it's kind of like this little drug we all feel. Like, it's just great, But remember, we've had so much fiscal and monetary stimulation. So I'm a little more on the cautious side, that we are facing a lot of things in 24 or 25.
So hold your horses for just a moment, okay? Jamie Dimon, what he just said there, 100% on it. 100%. The truth is the stock market drives so much sentiment. And when the stock market's going up, people naturally feel better and they have more of a rosy outlook on the economy. When the stock market's going down, they're like, oh, the economy's bad. It's just like, it was like, what comes first, the chicken or the egg, right? And it seems like a lot of times how the stock market's doing is what really drives the sentiment on how people feel about the macroeconomic landscape, how people feel about earnings and these sorts of things. It seems like that drives more of the sentiment than actually the data does, in my personal opinion.
Optimism?
Yeah, I think so. And I don't think that it means we're in for a big crash or a huge retraction. So here's kind of the way my math works out on that. When you say, has that sentiment, has that enthusiasm pushed valuations off sides? So the way I look at it is, if we can get to consensus earnings, which is $247 a share, that's assuming 11% growth over last year. You put a 20 times multiple on that gets you to 4,900. You put a 18 times multiple on that gets you to 4,400. So I look at it like a range. If we can have Rob's perfect scenario, right? Everything goes great. I think we get to 4,900. That's up 4% and change from here. If we're kind of in, valuations not being totally offsides, hovering at 18 times, that's down 7% from here. So I think it's offsides, but I think the magnitude this year should be more tame than what we've seen in the past 2 years. I mean, we're coming off of some crazy emotional swings, right? Thinking about 2022 with the market being down 18, last year with it being up 26. I kind of like where we are right now because we can point to anything, we can point to everything, anything, but I think the reality is we just need time to digest. And I think it's a pretty healthy, I would be thrilled if we end this year flat after a plus 26% year. So I think it's a healthy place to be in where we're not getting crazy with overly robust expectations.
What do you think about what Diamond said?
I think there are always concerns, whether it's geopolitical or economic. I think in 2024, yes, we have concerns. And I think one of those concerns is what you cited before, and that is ultimately what the direction of monetary policy is going to be. Are they going to make a mistake and stay too long? I think that's the risk, that they do stay too long. I also think when you take the totality of the first 17 calendar days of January, what's missing clearly to me is follow through. Follow through from where we were on Wednesday, December 27th, when a 10-year Treasury was 3.78, and we were talking about a 10-year Treasury falling to 3.50. You never got that follow through. And Scott, because you didn't get the follow through, once again, you're seeing that capital is frozen. You've talked to a lot of people in the asset management industry. They will tell you that a lot of the money that was in motion at the end of the year is once again frozen because you're challenged by a 10-year Treasury above 10%, and people are still sitting in those cash yielding equivalents.
Oh, okay, we're just ending it there. Alrighty, next one up here, Tom Lee on the volatile markets and what he's expecting here.
And I should have said that because you think the first part of this year, despite being bullish for the whole year, could be a little bit skimpy in terms of return.
Yes, Brian. I think we've got to digest that huge move you talked about.
Where's Tom Lee and what have you done with him? You were Mr. Bull last year. You were right on the mark about everything, and now you're a little more cautious.
Yeah, maybe it's because I skimped on the appetizers.
That's it. That's later.
Yes. Yeah, I'm still optimistic for the year. But, in the first half, and we got a glimpse of that today with Fed governors talking about not sure how many cuts they want to do. That's going to make markets nervous. And we got a pretty lousy Empire survey reading today, a regional PMI, and that's going to get people worried about a soft landing or hard landing. Those don't get answered for the next 6 months. So I think it's possible that we make a minor new high before the end of the month, and then we might have something like a 7% drawdown.
The Fed governor you're referring to is a gentleman named Christopher Waller, very smart guy, but he's not Jerome Powell. He is not the chair of the Federal Reserve. With all due respect to Mr. Waller, why is Wall Street suddenly paying so much attention to these one or two couple comments?
It's a fair question. We know for the last 2 years the Fed's been fighting inflation. So we know what that kind of regime and playbook is. Now we're moving to a playbook of, well, inflation is slowing. The Fed wants to keep real rates from getting too high, but we don't know what kind of cuts and when those happen. That's the nervousness we're going to have over the next 6 months.
I don't like to place too much credence in 1 month of data, particularly among some of these sort of smaller or more regional Fed surveys or surveys of this or surveys of that. You referenced one, though. This is the Empire Manufacturing Survey, folks.
And real quick here, something super important is, generally speaking, everybody's so excited about rate cuts. I've said this several times on this channel now. Usually when you're getting rate cuts, it's not good for the market. Everybody thinks like, oh, rate cuts, this is going to be great for the market. It's actually usually not good for the market. It actually means the market could actually go lower. And many times they're cutting and they keep cutting because, let's just say, the economy's getting worse. So I'm not super excited for when they do actually start cutting rates, just to be honest. Well, maybe my hedges are excited about that, but for my long positions, I'm not. Because then you really need everything to stay perfect in the economy to actually get the market to continue to roll. And a lot of times it's not realistic. They're cutting because things are continuing to deteriorate in the actual economy.
If you don't know what we're talking about, don't worry. 95% of you probably don't. It is a manufacturing survey around New York State. And usually it gets completely ignored by Wall Street. Nobody cares, except this data point, correct me if I'm wrong, Tom, came in so awful that even people who didn't care about this Empire survey suddenly started to care.
Yeah, it was pretty atrocious.
It was still awful, but you think it's just one noisy data piece?
There's a lot of things that can make it noisy. We know supply chains are being rerouted right now, and we know markets have been tumultuous. And, we've seen that during weeks of market corrections, regional surveys often tank because the purchasing manager might just say things are worse, but it's because the stock market's down. So it's really hard to know how much is signal versus other things contributing to it.
But I want to be optimistic today, and you do remain bullish. 5,200, correct?
Yes.
On the S&P is your price target for the year. That is not changing.
Yeah, I think investors who are long-term oriented should really just ignore the first 6 months. We have a Fed that's going to be shifting from being really tight to accommodative. Earnings are recovering.
Don't ignore the first 6 months. Take advantage of some deals out there, because if we get what Tom Lee's talking about here in the S&P 500, a 7% drawdown in the S&P 500, you got to understand that means probably a 10% plus drawdown in the NASDAQ, if he's correct on that, right? Which means countless stocks down between 10% and 25%. If he's accurate, which he might be, he might not be, but that's just something to keep in mind. So, make sure you take advantage of some deals out there if you do get presented with that opportunity, especially in big tech, because big tech, we haven't gotten crap for good deals in big tech since really 2022. So that's the real space. Like, if you get some opportunities there, take advantage.
Interest rates coming down, that's great news for consumers. And I think businesses in general have a CapEx cycle ahead. So, the stock market should do well this year. It's just, it doesn't mean it's...
CapEx cycle, the problem with that is that means company spending, which could hurt profitability of some companies. Just keep that in mind.
Well, that's about a 9% gain from where we are now. If you are also correct in that the market tumbles a little bit in the next couple of months, we all know it takes a bigger gain to get back to where you were after a drop because of something called math. So it's going to take maybe a 15% jump from the trough to get to that 5,200.
Yes, Brian, that's right. I think there's a chance at some point this year, maybe it's June, you have a chance to make 20% between now and year end. And I think small caps could make a bigger move, 50 or 60%. So I think there's still... What? Yeah, I think the IWM could end the year, Russell 2000 could end above 3,000.
Now,
okay, he just took it to another level. Man is now talking about 50 to 60% for small caps this year. My gosh, I'm waiting on that. Tom Lee, I hope you're correct. If there's ever one prediction I really, really hope you're correct on, oh my gosh, I hope you're correct on that one. Oh man, that would be beautiful. I appreciate everybody joining me as always. Thanks so much for being here, folks. Thank you for being subscribed to the channel. New all-time high subscribers in the history of the channel. If you're looking to apply, join my private group, get access to all my best courses, 6- and 7-figure Discord chat, all that good stuff. Pin comment down there, fill out an application. We see if we can get you in there later this week. Much love and have a great day.